The Bank of Canada did not change its rate today, but it did give us a clue as to when its rate might start to decrease. For the fourth announcement in a row, and as expected, the bank left its policy rate unchanged at 5%. This leaves the prime rate, or the retail rate from which lines of credit and variable rate mortgages are priced, the same at 7.2%. While this was expected, economists and data geeks like myself were looking for a change in the commentary that came with the announcement to get a better idea of when the bank might start to decrease its interest rate. Well, the bank did share a few observations today. The first is that the bank was clear that economic growth had essentially stalled since mid 2023 and that it's expected to stay that way for a few more months. They point to higher interest rates and higher prices combined as reasons that people are spending less. So, those higher interest rates, that's exactly what they're looking for by doing that. Now, the other one is that Governing Council also wants to see further and sustained easing in core inflation. Core inflation is the inflation number that's measured when energy like fuel and gas and electricity, as well as food, those are very volatile items. So they want to see that inflation is in control when excluding those items. And I'll address that a little bit more when I talk about retail sales growth. While fixed mortgage rates are not directly tied to changes in the Bank of Canada rate, they are highly impacted by the bank's changes. With recent expectations that the bank may start lowering its rate as early as March, we are seeing bond yields and fixed interest rates decrease substantially from their multi-year high in October. Even though inflation headline rate has ticked up a bit in December from 3.1% to 3.4%, there is still a lot of reason to believe that it will settle down close to its target rate of 2% by mid-2025, which will mean broad price stability for Canadians. Some recent data, including a different look at GDP, which is the primary measure used for economic growth, gives a picture of overall economic weakness in Canada that will surely not only reduce demand further, but will also push the bank to a position of needing to stimulate the economy. Retail sales growth is trailing population growth. That's the red line on the screen here, and that means that the increase in sales at stores is less than the increase of the number of people who are here to spend in stores. So in reality, that is a decrease. The retail inflation caused largely by supply chain difficulties and extra money in the economy from government spending during COVID was a very big factor in inflation nearly 2 years ago, but that has mostly worked its way out of the system. You can see that on this graph here as the red peak early on the line, and then its subsequent decrease compared to the inflation, which is shown by the orange line. GDP overall in Canada is increasing, but just barely. And that's what the government or the bank was talking about when they said growth has more or less stalled. It is still positive, but barely. When looking at GDP growth per capita or per person, that's the blue line on the screen here right now. It's actually trending about negative 2% or so. This means that the economic output of our country is growing, but slower than our population. It doesn't mean that immigration is the problem, but our increasing population, it's masking overall economic weakness. The economic team at Desjardins Bank explained recently that much of what's left driving the above target inflation is attributable to shelter, which in turn is being driven by higher interest rates. If we exclude shelter, now inflation is only running at 2.4%, and that's down from 6% on the same calculation only a year ago. Of course, if we exclude items that are rapidly rising in price, the inflation measure will be lower. But the key point is that the bank's own policy is responsible for the high rate of mortgage interest cost inflation. So taking mortgage payment and rent inflation out of the picture, we've already arrived within sneezing distance of the bank's target. Reducing interest rates will generally have the effect of reducing, or at the very least stopping, the increase in that component for both homeowners as well as for renters that are paying more in part due to higher mortgage costs seen by their landlords. Reuters recently polled economists, and 65% of them said that the bank's first rate cut would probably be in June or a little bit after that. I personally do agree with this, and I believe that June's announcement is when we're going to see the first decrease to the bank's rate. And from there, really, it's a question of how quickly will the rate decrease and how far will it decrease. Capital Economics is a respected economic think tank, and they predict that the total decrease over the upcoming cycle will be 2%. And they expect that this is going to actually be done by summer of 2025. So in the next 16 to 18 months or so. The end of this current cycle of high interest rates is in sight. That will likely spur more real estate activity. We know that Calgary real estate's already outperforming most of Canada, and Edmonton will likely see a marked increase in sales and an uptick in property values as the interest rates head downward over the coming months. So as always, if you are thinking about purchasing a home, remortgaging the home you already have, maybe a debt consolidation or something else, or if you have a mortgage that is up for renewal, this can be complicated. So please reach out to my team and we will help you to analyze this complicated time and optimize success for you in your home ownership.